Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Wd-40 Company Quarterly Report. Wd-40 Company offers a diverse range of products across various categories. The company's flagship brand, Wd-40 Multi-Use, provides multi-purpose maintenance products such as aerosol sprays, non-aerosol trigger sprays, precision pens, and liquid bulk form products. In addition to its core offerings, the company also provides specialty maintenance products under the Wd-40 Specialist brand. These include penetrants, degreasers, corrosion inhibitors, greases, lubricants, and rust removers. The 3-in-1 brand offers drip and specialty oil lubricant, as well as specialty maintenance products. The company's product portfolio also includes home care and cleaning products under various brands such as 2000 Flushes, automatic toilet bowl cleaners, Spot Shot aerosol and liquid trigger carpet stain and odor eliminators, carpet fresh room and rug deodorizers, Lava and Solvol bar soap and liquid hand cleaner products, X-14 automatic toilet bowl cleaners, Novac carpet and fabric sanitizers and deodorizers, spot stain cleaners, and 1001 and 1001 carpet fresh room and rug deodorizers. Wd-40 Company sells its products through a wide range of channels including hardware stores, automotive parts outlets, industrial distributors and suppliers, mass retail and home center stores, value retailers, grocery stores, online retailers, warehouse club stores, farm supply, sport retailers, and independent bike dealers. Wd-40 Company maintains a market capitalization of $3 billion, broadly in line with the industry peer group. Wd-40 Company trades at a higher price-to-earnings ratio of 38 times and a higher price-to-book ratio of 11.4 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 44% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through an analysis of the key factors that contributed to changes in net sales over a given period. On one hand, revenue growth was driven by several factors. Net sales increased by 10.7% in 2026 compared to 2025, with significant growth in maintenance products worldwide and within specific regions such as Asia-Pacific. The Wd-40 multi-purpose product also saw a notable increase in revenue, rising by 21.4%. Furthermore, the HCCP segment experienced substantial growth, with sales revenue increasing by 49.1%. On the other hand, revenue decline was observed in certain areas. Sales of home care and cleaning products decreased due to assets being held for sale, while the HCCP segment saw a significant drop in revenue following the sale of the business in EIMEA during FY 2025. Additionally, distributor markets in Saudi Arabia and UAE experienced decreased volumes due to timing of customer orders resulting from strategic distribution changes. In terms of stable revenue growth, it is worth noting that there was no significant change in gross margin, cost of doing business, or adjusted EBITDA between 2025 and 2026. This suggests that the company's financial performance remained relatively consistent over this period, with revenue growth driven by specific product lines and regional markets rather than overall changes in profitability. The net income and profit margins of the company underwent significant changes between 2025 and 2026. For the 3 months ended February 28, 2026, the net income decreased by 32% to $20.3 million compared to the previous year's $29.8 million. This decline was also observed in the 6 months period, where the net income dropped by 23% to $37.8 million from $48.7 million in 2025. The decrease in net income can be attributed to various factors, including the release of uncertain tax position in the prior fiscal year, which had a negative impact on the company's earnings. However, excluding one-time benefits, the net income would have increased by $0.9 million. On the other hand, profit margins showed an improvement, with gross profit margin increasing by 100 bps to 56% for the 3 months period, and by 120 bps to 56.4% for the 6 months period. The sale of home care and cleaning product brands in the EIMEA segment also contributed to the decline in net income. Despite these challenges, the company's profit margins remain stable, indicating that the business is still profitable despite the decrease in revenue. Overall, the changes in net income and profit margins reflect the complexities of the company's financial performance and the need for careful analysis to understand the underlying factors driving these trends. The company is experiencing a significant increase in its ability to generate positive operating cash flow. According to the financial statements, net cash provided by operating activities has increased from $22,908,000 in 2025 to $24,281,000 in 2026. This indicates that the company's operations are generating sufficient cash to cover its expenses and investments, resulting in a positive operating cash flow. The company's debt levels and interest expenses have undergone some changes over the past year. According to the extracted summaries, total borrowings increased by $14,213 from $86,995 to $101,208 as of page 21. However, this increase is relatively small compared to the overall debt level, which stood at $137.1 million as of February 28, 2026. In terms of interest expenses, there has been a decrease in both the 3-month and 6-month periods ended February 28, 2026. Specifically, interest expense for the 3 months was down by $355,000 from 2025 to $666,000, while the 6-month period saw a decline of $580,000 from 2025 to $1,314,000. While there are some fluctuations in debt levels and interest expenses, it is difficult to conclude that there has been a significant change across all periods. The increases in borrowings and decreases in interest expenses seem to be relatively minor compared to the overall financial picture of the company. The company's performance across various segments and regions has been mixed. On the positive side, the Americas region has shown significant growth, with a plus 14% increase in operating income for the first quarter CONE and a plus 16% increase for the first half HONE. The Asia-Pacific region also performed well, with an 18% increase in operating income for CONE. In contrast, the EIMEA, Europe, International Markets and Emerging Economies segment struggled, recording a minus 2% decrease in operating income for CONE and a minus 3% decrease for HONE. These results indicate that while some regions are thriving, others are facing challenges that need to be addressed. Management is optimistic about the company's outlook and strategy. A key aspect of this is the share repurchase plan, which authorizes the acquisition of up to $50 million worth of outstanding shares by August 31, 2026. This move suggests that management is confident in the company's financial health and believes its stock is undervalued. In terms of growth, management has identified the core business as a key area for expansion. Resources from divested brands will be redirected to support this effort, indicating a focus on streamlining operations and allocating resources efficiently. Management also aims to maintain a gross margin between 50–55% and keep costs at around 30–35% of net sales. The company's financial stability is another key aspect of its strategy. Management believes it has sufficient resources to fund various activities, including short-term and long-term operating requirements, capital expenditures, dividend payments, acquisitions, new business development activities, and share repurchases. Additionally, the company will continue to monitor its debt covenants and has a plan in place for managing its credit facility. Overall, management's statements suggest that the company is well positioned for growth and financial stability, with a clear focus on its core business and efficient resource allocation. The company has made several divestitures in recent years. In the fiscal year 2025, it sold its home care and cleaning products, HCCP, business in EMEA for $1.5 million in the first quarter and $3.1 million in the second quarter of that year. Additionally, certain home care and cleaning product businesses were classified as held for sale as of February 28, 2026. The company has also announced plans to sell its HCCP business, but no specific details have been provided. The expected benefits from these divestitures include increased focus on core operations and reduced financial burdens. However, the announcement or completion of these transactions may disrupt the parties' businesses, and there is a risk that the company may not be able to successfully complete them. The expected timing for the closing of any divestitures has not been specified, but it is anticipated that the proceeds from these sales will have a positive impact on the company's financial performance. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In terms of dividends, the company paid out a total of $26,544 in 2026, with a declared dividend rate of $1.02 per share for that year. This indicates that the company distributed a significant portion of its earnings back to its investors. The company also engaged in share buyback activities in 2026, purchasing shares worth $15,835 and repurchasing an additional $9.1 million worth of stock. These actions demonstrate the company's commitment to enhancing shareholder value through strategic capital allocation decisions. There are concerns about inventory buildup in the company's operations. The data shows that inventory levels have increased significantly from $79,871,000 to $85,545,000, indicating a potential issue with managing stock levels. Additionally, contract liabilities and minimum purchase obligations suggest that the company may be accumulating too much inventory, which could lead to waste or obsolescence. Furthermore, distributors were carrying high levels of inventory after successful promotional programs in fiscal year 2025, implying that the company's sales strategies may not be aligned with its inventory management. Temporary measures are being taken to manage supply chain constraints and transportation disruptions, which may also contribute to inventory buildup. In contrast, there is no explicit concern about supply chain disruption mentioned in the report. While ongoing relationships with suppliers and third-party contract manufacturers may indicate potential risks, these are not direct concerns. The only mention of a specific issue is supply chain disruptions within the EIMEA segment for Middle East Distribution Network, but this does not seem to be a widespread problem. That concludes the financial summary for Wd-40 Company. Feel free to comment below, and I will be happy to answer them when possible.